Good day. Today we're talking about flow-throughs and super flow-throughs and how they can impact your tax situation. I'm Rob Tatro from robtatro.com, head of the Tatro Wealth Advisor Group here at Canaccord Genuity Wealth Management. Thanks for tuning in, folks. Take a quick second and subscribe to our videos. Now let's get right into it. Flow-through shares. Now there's a lot of noise that's been made in the past 5, 10, 15 years about flow-through shares. Now let's get back to the actual facts, the actual basics. What is a flow-through share? A flow-through share is a share of a common stock, a common security that trades on either the Venture Exchange or the Toronto Stock Exchange. And in exchange for giving them money, they will flow through the tax credit that they receive from the government for either development or exploration. They will flow that tax credit over to you, the shareholder. So you invest in them, they get the tax credit, they don't use it, they flow it through to you. Generally, they are not profitable. These companies are usually junior companies, usually smaller companies that are either starting out, they're exploring. They're typically going to be what's called penny stocks or junior, small cap, micro cap stocks, usually volatile companies, highly speculative, highly risky. Now, who are these investments for and what do they actually do? Let's start about what they actually do. So you invest in a company trades on Toronto Stock Exchange. Let's call it $1. I put $1 into this company and I will get, there are two types of credits. Let's start with the CEE, the Canadian Exploration Credit. The CEE is a 100% tax deduction in the year that you've purchased these flow-through shares. So you buy a share for $1, you get the full tax deduction right away, and you can then offset that against your income. Now, there's a couple things you need to factor in because there is a taxable nature of the shares when you do sell them. So they will be treated as a zero cost base for these shares. But leaving that aside, to stick to the basics of this deal, I buy a share, I get the full tax credit in year one. I need to hold on to the shares for a period of time. And when I do sell them, hopefully the shares are either at the same price that I bought them or maybe they're even a little bit higher. And then I would have made a bit of money on the shares and I also got the full tax credit. Ideally, you made a ton of money on the shares, but even if you don't make money on the shares, flow-throughs can be a very, very good investment because of the tax credit. Now, these work really, really well for people who are in the top tax bracket. So if you're making above $200,000 a year annually of income, of T4 income, flow-throughs can be a very, very efficient use because you've used your RSP contribution room, you've maxed out the RSP, and now you're left with no other avenue to invest to reduce your tax bill. So if you want to reduce your tax bill, it's another option. The other credit that we talked about earlier is the CDE credit, the Canadian Development Credit. So for this one, you generally write off the tax deduction over 3 years, 3 or 4 or 5 years, but generally 3 years, about 30% or so in the first year, and you spread the tax deduction over multiple years. So if you're going to be doing a flow through with that credit, you need to make absolutely sure that you will be in a top tax bracket for those years. Otherwise, you're missing out on the deduction. Flow throughs really only work for people who are in the top tax bracket or near the top tax bracket. All right, so you've invested in this company, you now own the shares of this flow through. What price did you pay for your shares of your flow through? So generally, there is what's called a premium to buying flow through shares. So if the common shares are trading at $1, call it $1, you'll typically see anywhere from 20 to 30% premium on the CEE exploration credits, and you'll typically see anywhere from 8 to 15% on the CDE credits. Now, you're paying a premium. You're paying more for these shares than you could buy them in the market. And the reason you're paying a premium is because you are getting that tax deduction. So it's a trade. They're giving you the tax deduction in exchange for more cash than they normally would raise. These are typically done through an issuance, a share raise as we would call, or an equity raise. And typically companies will issue these throughout the year. Now, historically, these were done a lot more one-offs, but in the last 5 or 10 years, I'll say 5 years or so, there's been way less appetite for flow-through shares. So what's happened is the market has kind of conglomerated itself, and we're now seeing these larger groups, these mutual funds, if you will, of flow-through shares coming together, buying 5 or 10 or 15 different flow-through shares, and then you end up owning a mutual fund of flow-through shares. So that's been more or less the strategy in the last 5 years. We still see from time to time the flow-through issuance, which is a one-off, which you could participate in if you deal with an investment brokerage house. Let's get one thing very, very clear with respect to flow-throughs. They are extremely risky. They are extremely speculative, and these do not form part of a well-balanced portfolio. They're usually either exploratory mining companies or exploratory oil and gas companies. And when we say exploratory, they haven't struck anything yet. So these are often very risky junior companies, and just know what you're getting into if you're going to do a flow-through. Make sure you talk to your advisor about it, and make sure you're fully aware of the tax consequences of buying these flow-through shares, and make sure you're aware of the length of time that you need to hold these flow-through shares before you qualify for the credit. Now, they can work ridiculously well, because imagine you buy a share, the share goes up, and you get the full tax credit. That is a huge win for your portfolio. But they could also go the other way. The shares could also go to zero, so you have a complete loss, a complete failure, if you will, on the value of your shares, and all you got was a tax deduction. So you should never be buying a flow-through simply for the tax deduction. You should buy it because you like the company, you like the sector, and you think the tax deduction combined with the company is going to be a beneficial portion of your assets. Finally, real quick on super flow-throughs, there are certain provinces that will have even another tax deduction. Manitoba is one, Quebec is another, BC is another, where they will allow you another super flow-through deduction if you live in the province where the development or the exploration is happening. So in Manitoba, for example, if there's a company in northern Manitoba that's exploring for a mine, they will give you a super flow-through tax credit, which can bring your cost of investment down to about 25 or 30 cents. It's really dramatic, and in those situations, the tax savings are fantastic and phenomenal. Again, these are risky companies, but they might work out for your portfolio. Super flow-throughs, tax tools used to plan and also mitigate some tax impact above the RSP. Really interesting stuff. Less and less appetite nowadays. Feel free to give us a buzz, give us a ring if you'd like to know more about some specific offerings that we do have for flow-throughs and for super flow-throughs. Please give us a share, give us a follow, give us a like. I'd love to hear your 2 cents on flow-throughs. Maybe you've been burned with flow-throughs in the past. Maybe you struck it rich. I'd love to hear about it. I'm Rob Tatro from robtatro.com. Thanks for watching.